and happy Tuesday, May 19th. This is your host, Michael Thomas. Welcome to another exciting edition of Rate Desk. Here to talk about multifamily interest rates, among other news. Hey, in the markets today, they're down. So there was some news that came out regarding a vaccine, not enough data, I guess, to move forward expeditiously. So the markets came down a bit today on that, and also some of the big retailers and their numbers were not looking so rosy, which isn't a huge surprise. Good news for crude oil futures are that they stayed in the $32 a barrel range. U.S. 10-year Treasury yields down a bit today from yesterday, shedding about 4 basis points, which is something you sometimes see when people leave the stocks and they sell off. They buy U.S. Treasuries. That drives the prices up. The yields come down because they move inversely to each other, as we all know. Now, in other news, jumping into the multifamily interest rates, not seeing too many major moves. There is one interesting move on agencies. We'll talk about that in a second. Going over to HUD FHA 223-up fixed for 35 years. We're looking at a 252. That is 2.52 fixed for 35 years. Jumping over the 221D4, we're looking at 317, 3.17 fixed for 40 years. Now jumping on over to the agency desk, shedding just 1 little basis point down to 320 today. And here's the interesting move. Freddie Mac has really shaved off a bit. If you recall, yesterday and for a while, we've been quoting up to the 335 range. They've shed 15 basis points. What does that mean? That means they're at parity with the other GSE, Fannie Mae. So both are now trading at 320 on 10-year fixed rate money. Interesting, and something you don't always see in the markets with them trading at the parity rate. So anyway, thought that was kind of fascinating. Now into other news, 3 things I want to talk with you about today. The first of which is the HUD Eastern office is busy. The Baltimore office has been communicating and letting us know that they are quite busy. They are holding off on concept meetings. They are calling for backup, getting some backup support in their back offices so that they can accept a large application volume. As you might imagine, times like this, HUD really is the lender of choice and last resort. So there's a lot of applications in all the offices, particularly in the Eastern offices. We're talking New York, Baltimore, the Philly areas. Very busy with HUD applications. Glad to see that they're getting the backup so they can keep on trucking. Statutory waivers, we talked about those in a previous episode. Statutory waivers in high-cost markets like New York, California, heck, even Denver. 270% is the multiplier. That is what is already currently published. Good to hear that now going up to 315 isn't too big of a stretch. There's been several deals approved at that range. There might be some more official guidance coming out on that in the future, but for now, good to see that the 315% multiplier is more of a common thing in these high-cost markets because, as you know, it can cost a lot of money to build in California and in New York. So that's a positive thing. Want to move on to bridge lending. I did speak to a bridge lender today, and he called himself a true bridge lender because a true bridge lender in the old days used to lend on an unstabilized type of an asset and lend on it to the stabilization period. A lot of bridge lenders today really want to see a fully stabilized asset that they're lending on so they can sell them right away to a commercial loan obligation portfolio or a CMBS portfolio. Both those markets not so active right now. So this guy has no problem moving forward. Gave me a quote, 65% on the loan to cost going in, up to a 75% on the 3-year value. Looking at the LIBOR plus about 500 basis points. So call it 5.25 roughly today. Not too bad. I thought the leverage quote was good. Most importantly, the value quote, and that it doesn't really have to be one of those properties that's occupied at 93% or above. So really positive to hear that. Thought that was good news. On the FHA multifamily front, again, just thought I'd bring this up because it's come up on a couple calls recently. Single family housing rentals going to the HUD FHA multifamily program not so much. The Southwest office, not a big fan of that property type. Duplexes are not considered the same, but the true single family rental structure, not quite the flavor that office is looking for. There really is no official guidance. What we're talking about here are policy decisions. Policy decisions and interpretations can vary from HUD office to HUD office. So I would say, talk to your lenders, see what's available. And I'll also mention this, affordable housing really does have a very different lens. If you've got a low-income housing tax credit portfolio, which may include single-family rentals, don't give up, talk to your lender. Sometimes affordable housing is viewed in an entirely different light. It is the mission of HUD to provide access to that type of housing, so you might get more favorable treatment there. I will end on that positive note. Thank you for tuning in. This has been another edition of Rate Desk. I'm your host, Michael Thomas, signing off.